Friday wasn't just a market correction, it was a crime scene. And if you know where to look, the fingerprints of the biggest bank in the United States are all over the weapon. But this time, something went wrong. This time, in their attempt to crush the silver market, they may have accidentally broken the entire financial system. We are heading into a Monday morning that could redefine the global economy, and 99% of the world is completely asleep at the wheel. They saw the red charts, they saw the panic headlines, they think the silver bull run is dead. They are wrong. Because while the world was watching the price collapse, a source with high-level clearance has just leaked information that changes everything. We are hearing reports of a major bank facing total insolvency. We are talking about a liquidity event that echoes 2008, but with a severity that makes the Great Recession look like a dress rehearsal. And the catalyst wasn't housing, it wasn't tech stocks, it was silver. But that's not even the craziest part. The data suggests that JP Morgan didn't just survive this crash, they orchestrated the exit. They left a breadcrumb trail in the COMEX reports that reveals their entire strategy for the rest of the year. And if you missed what happened at the Perth Mint just hours before the price fell, you are missing the most critical piece of the puzzle. Sit down. Focus. Because what I am about to tell you isn't speculation. It is a mathematical certainty based on the data that just hit the tape. We need to talk about why silver crashed, why a bank is allegedly dead in the water, and why JP Morgan just signaled that the bottom is officially in. To understand why this Monday is going to be so critical, we first have to dissect the violence of what happened on Friday. This wasn't normal trading. This wasn't supply and demand finding an equilibrium. This was a liquidation event, the likes of which we have not seen in nearly half a century. Silver spot prices plummeted by as much as 35% during intraday trading. We saw the metal smash down below $75 an ounce. Now, for the casual observer, that looks like a bubble popping. That looks like the end of the party, but you need context. This was the single biggest daily decline in 46 years. You have to go back to the Hunt Brothers era, to the late 1970s and early 80s, to find volatility this extreme. When an asset moves that violently, that fast, it isn't natural selling. It is forced liquidation. It is a margin call cascade designed to flush out every single weak hand in the market. The mainstream financial media is already writing the obituary for silver. They are telling you it's over. They are telling you to sell what you have left and run for the hills. But they are leaving out the most important statistic of the entire month. Despite the carnage, despite the algorithmic selling, despite the historic 35% intraday drop, silver closed the month of January in the green. It finished up 19%. I want you to really visualize that. Imagine an asset taking the hardest hit it has taken in 46 years and still finishing the month with nearly 20% gains. That is not weakness. That is resilience. That is a market that wants to go higher, but is being held underwater by paper contracts. This marks 9 consecutive months of gains for silver. 9 months. In the world of technical analysis, that is not a fluke. That is a structural fundamental shift in how the world values this metal. The trend is undeniable. And that is exactly why the powers that be tried to break it on Friday. They threw everything they had at this market, they emptied the clip, and silver is still standing. Now, we need to talk about the elephant in the room. We need to talk about the bank that owns the silver market, JP Morgan. If you think markets are random, you aren't paying attention. Because what JP Morgan did during Friday's chaos wasn't just a trade, it was a message. We have analyzed the latest COMEX data, digging deep into the positioning reports that most people ignore. And what we found is staggering. During the absolute peak of the panic, while retail investors were selling their positions in terror, JP Morgan was doing the exact opposite. They closed 1,959 short positions. But it's not just that they closed them, it is where they closed them. They executed these covers at exactly $75, not $76, not $74, exactly at the bottom. They caught the falling knife with surgical precision. They knew exactly where the algorithm would stop. They knew exactly where the floor was. How is that possible? How does a bank with that much exposure time the bottom of a 46-year historic crash to the penny? It's possible, because they are the ones who likely set the floor. By closing those short positions, JP Morgan has effectively flipped the switch. For months, they have held massive short positions, profiting from or hedging against downside risk. By covering those shorts at the mathematical bottom, they have removed the ceiling. This is JP Morgan's way of leaking their plan to the insiders. They are signaling that the suppression phase is over. They are signaling that they have extracted maximum value from the shorts, and they are now positioned for the reversal. If the biggest shark in the ocean stops swimming down and starts swimming up, you do not want to be betting against them. Their order flow is the only indicator you need. They are telling us that $75 was the line in the sand. And if JP Morgan is betting on the bounce, you better believe a bounce is coming. But why the panic? Why the 35% drop? Why the desperation? This brings us to the most terrifying piece of intel we have received. A source with high-level Federal Reserve clearance has communicated something that explains the violence of Friday's move. There are whispers, credible, high-level whispers, that a major bank is insolvent. The word being used is liquidated, gone. This isn't just about losing money. This is about a margin call so large, so catastrophic, that the institution could not meet it. The source compared this to 2008, but with a caveat that should keep you awake at night. They said the depth of this hole is potentially 100 times deeper than what we saw in the great financial crisis. Think about the mechanics here. If a bank was massively short silver, betting on a collapse back to $30 or $40, and the market ripped for 9 straight months, their losses would be infinite. As silver climbed to $117, those short positions became toxic waste. It is highly probable that Friday's crash was a forced liquidation event. It wasn't market sentiment, it was a bank being taken out back and shot. The system forced a sell-off to cover the bad bets of a dying institution. And now, we are in the limbo of the weekend. The markets are closed, the lights are off, but inside the boardrooms of Wall Street and the Federal Reserve, the lights are burning bright. They are trying to figure out how to handle Monday morning. If a bank has failed due to silver exposure, we are looking at a contagion event. We are looking at counterparty risk that spreads through the entire derivatives complex. Monday morning isn't just another trading day, it is a judgment day. While the paper market is burning down, the physical market is screaming a completely different reality. And this is the disconnect that every single viewer needs to understand. And while spot price was crashing, the physical metal was disappearing. Look at Australia. Look at the Perth Mint. This is a government-backed facility. It is one of the most reputable high-volume mints on the planet. And on Thursday, note the timing before the crash, they suspended sales. They stopped taking orders for the 2026 Kangaroo 10Z silver bullion coins. They put wholesalers on an allocation system. That is a fancy word for rationing. They issued a statement saying they have a large backlog and need to pause wholesale orders until February 23rd. They cannot keep up. Now, connect the dots. Silver was trading near $117 when they made this decision. At $117, demand was so high that a government mint ran out of capacity. So what happens now? What happens now that the price has been smashed down to $75? If people were buying so much silver at $117 that the mint broke, what do you think they are going to do at a $40 discount? We are about to see a demand tsunami. Every investor who felt priced out at the top is now looking at this crash as the opportunity of a lifetime. Every industrial buyer who needs silver for solar panels, for electronics, for missiles, they are not selling. They are backing up the truck. The Perth Mint was just the first domino. It was the canary in the coal mine. If a government mint cannot source enough blanks to meet demand at high prices, the physical market is incredibly tight. Now throw a 35% discount on top of that shortage. You're going to see premiums explode. You're going to see out-of-stock signs across every major dealer. The paper price says silver is worth less. The physical reality says silver is unobtainable. This divergence is the death knell for the manipulation game. You cannot suppress the price of something that doesn't exist. You cannot short a phantom. This leads us to the core thesis of what is happening right now. We are witnessing the breaking point of the paper derivative market. For decades, banks have controlled the price of silver by trading paper contracts that represent hundreds of times more silver than actually exists in the vaults. They use this leverage to smash the price, to shake out retail, and to keep the fiat currency system looking stable. But Friday feels different. Friday feels like the gears of that machine finally stripped. If a bank is truly insolvent, it means the leverage finally caught up to them. It means the physical squeeze became so intense that the paper games stopped working. Maybe they couldn't source the metal to deliver. Maybe their collateral collapsed. Whatever the specific trigger, the outcome is systemic failure, and JP Morgan knows it. Why did they close their shorts at $75? Why didn't they press it lower? Why didn't they try to drive it to $50? Because they know $75 is the physical floor. They know that if they push it any lower, the physical buying will be so overwhelming that it will break the comics. They know that at $75, the industrial users will drain the vaults dry. JP Morgan didn't cover out of the goodness of their hearts. They covered because they reached the limit of what the manipulation could achieve. They looked at the physical market, they looked at the Perth Mint rationing, they looked at the insolvent bank down the street, and they said, that's it, we're flipping long. They are now positioned for the upside. They are ready for the rocket ship, and they left the other banks holding the bag. So what does this mean for you? What does this mean for the person holding silver or the person thinking about buying? We are walking into a week of absolute uncertainty. If the insolvency rumors are true, we could see emergency intervention from the Federal Reserve. They cannot let a bank fail because of a commodity trade. It would expose the weakness of the entire system. So what do? They print, they provide liquidity, they bail out the bad actors. And what does money printing do to the price of silver? It sends it to the moon. The very mechanism they use to save the system is the fuel for the next leg of the silver bull market. It is a paradox they cannot escape. Furthermore, watch the physical premiums. With the Perth Mint down and price crushed, dealers are going to jack up premiums to protect their inventory. You might see spot price at $75, but try buying an Eagle or a Maple for anything less than $90 or $100. The disconnect is going to widen. This is the opportunity. This is the moment where wealth transfers happen. When the paper market panics, the smart money looks at the physical reality. They see the rationing, they see the deficits, they see JP Morgan changing sides. The crash on Friday was designed to scare you. It was designed to make you think the run is over. It was designed to make you sell your hard assets for paper currency. But if you look at the data, if you look at the 9-month green streak, if you look at the short covering, it tells a different story. It tells you that this was the final shakeout. It tells you that the spring is coiled tighter than it has ever been. We are watching a manipulated market collide with unmovable physical laws. And the paper market says, sell. The physical market says, we are out of stock. History shows us who wins that battle. Reality always wins. As we head into Monday, keep your eyes on the news. Watch for announcements about banking stability. Watch for more mints suspending sales. Watch the price action on the open. If we see a violent reversal, if we see silver rip back up, it confirms everything we have discussed today. T confirms JP Morgan's bottom. It confirms the insolvency capitulation. We are living through history. 46 years from now, people will look back at this chart. They will look back at the day silver crashed 35% and then launched into the stratosphere. Do not let the volatility shake you out. Do not let the paper games blind you to the physical shortage. The bank is insolvent. The mint is broken. The shorts are covered. The deck is cleared. This is the hidden economy. And the real move is just getting started. I want to know what you think. Is Monday the start of the recovery or the beginning of the collapse? Let me know. And if you want to stay ahead of this story as it breaks, make sure you are subscribed. Because the mainstream media isn't going to tell you the truth until it's too late. We'll be watching. We'll be waiting. And we'll be ready.